Alrighty, welcome to week 4, lecture number 2. Quick look at review question. This will show up, something like this will show up on the midterm. I actually did a lecture slash video for going through the actual little exercise, so I'm just going to mention it. It's called cash flow statement in week 4. Okay, just a quick, in a nutshell, review of our 3 financial statements, our main ones. Income statement, of course, tells us whether or not the business made a profit during the time period involved. Balance sheets tells you exactly what your company looks like at the end of the period that matches the end of the income statement, and the cash flow statement tells you about the period, about the period during which you had the income statement, and it tells you where your money went to and from. Okay, income statement tells you that you might have gotten some money if you had a profit. Balance sheet says here's where it's all at. The cash flow statement says here's where it came from and went to. Okay, classifications on the cash flow statement. Operating activities. Hopefully that's when you're making sales and incurring some expenses but making some profits. Okay. Transactions a business engages in to make profits. That little bit on the cash flow statement tells you the money that came in, again, if you have profits, from your daily activities, from your operations. Okay, investing is the acquiring of long-term assets or capital expenditures. Capital, of course, meaning long-term. And sometimes we have to sell those long-term assets when they're done. We typically don't do that. And typically a company is selling their long-term assets, either the assets all used up or they're selling it because they're not doing too well. So we're going to just look at the best case scenario where maybe we buy some. And lastly, the financing activities, we borrow money. Okay, that's one source of cash. We can raise money through equity or selling shares or stock or whatever you want to call it, or additional investments by owners. That's, again, money in. And then for the loans, we return the capital, okay, paying off the loans, the principal, whatever you want to call it. And on the dividends, or excuse me, on the shares, we pay our customers back, or our investors back with dividends. So those are all considered financing activities: borrowing and paying capital back, getting some investment money, and giving dividends back. Okay, and of course, one other financing activity, real stretch here, would be the actual operating, but because we can finance some of our purchases of long-term assets from our profits, but we don't break it up that way on the cash flow statement. It's just operating, investing, and financing activities. Okay, so some more review. A profitable company doesn't necessarily generate high cash flow. I'm going to say instant high cash flow, because if it sells on credit, you might not get paid for a month or two. So there's a bit of a lag in the actual cash coming in. And that's because we engage in accrual accounting. So we match the sales and the expenses. And sometimes we don't even pay for the expenses or the inventory at the same time as things happen, or we sell them. So that can skew things a bit. This is important because we have to manage our cash flow as financial managers or business owners, and we have to pay our employees with cash or something equivalent to that. Else they don't stick around. Okay, so the statement of cash flow reports changes in cash and cash equivalents resulting from activities of the business during the given period. And that's the end of our quickie cash flow review.